All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Randy Langenderfer, and he's the president of InvestArc Properties, which focuses on creating investor value and passive income results for busy professionals in multifamily real estate. He actually is both a GP, a general partner, meaning he's managing assets for himself and his investors, and he's also a limited partner, which means he's investing passively in multifamily real estate. So he has a unique perspective that is pretty unique in the industry. Typically, it's usually one or the other. So he provides both, and we want to talk about both and what he looks for as a passive investor in sponsors, and then a little bit about his general partnership platform as well. But Randy comes from us in suburb of Houston, which is a really hot market right now. He targets and owns in a few states, and very excited to have him on the show and looking forward to the discussion. Randy.
Anthony, it's my pleasure. It's great to be here. Let's provide some value to your audience today.
Sure. So how did you get into multifamily? Did you start out as a general partner or limited partner? Like, what was the steps you took to get to where you are today?
Well, thanks again for the opportunity. Great question, and it's a long answer that I'll try to abbreviate here. But my journey started when I was, I'm still an active W-2 employee too, so I have that perspective for your audience. I'm an active W-2, I'm a GP, and I'm an LP. I really love this space. I spend a lot of my free time doing it. It's not work to me. But the answer to your question is when I relocated to Houston, Texas from the Cleveland, Ohio market in 2013. And I had been involved in single family as a hard money lender prior to that. After the Great Recession of 2008, 2009, I'd become a hard money lender in the single family space. I came to Houston for my W-2 purposes and found multifamily and kind of have never looked back. And so the journey started like many in single family, but it just became very time consuming, and looking at every deal and to get leverage and to get scale, it just became very time consuming to look at every deal, look at the repair budgets, evaluate the markets, know the people who are actually doing the deals. And as a kind of a boutique shop, small shop, multifamily just makes a whole lot more sense.
Sure. So you moved for the W-2, you were doing some hard money lending, and then you found commercial multifamily. So how did you just buy a 1,000-unit apartment building by yourself? Like, how did that end up happening?
Well, I wish I had the net worth to buy a 1,000-unit multifamily by myself and just live off the cash flow. But the short answer is, came to Houston. I attended Lifestyles, a large educational group here in the Houston, Texas area. I was there for a short period of time, and I learned the introductory to multifamily there, but ended up going to the Brad Sumrock group in Dallas, Texas for about 3.5 years. And that's where I really learned the tools of underwriting and learned all the different aspects of multifamily general partnership activities. Today, I'm in Rod Khleif's organization as a coach and part of his personal mentoring program. And so it's, I've seen 3 different groups, and I've gotten, I think, the best of all of them and going forward. And so I think that's another unique perspective I bring. And you see people coming out of different organizations, and they tend to be very centric or stylistic. And I've tried to include the best of all of them.
That's excellent. So can you talk about that educational component, like how it sounds like you're still going through some of it too, which is great. Everybody should, be learning every single day, even if you've been around for a while. Can you talk about how important that was, and even whether it's on the active side of real estate and the passive side? Can you talk about both?
Happy to do that. Yeah, I think it is paramount. I said, no matter where you're at in your real estate journey, I always give the illustration. Many of us spent a lot of money going to college or trade school and graduate programs, et cetera, a a lot of money doing that, and yet we don't want to invest in ourselves in our real estate education. So I really think that education, like in your business world, is paramount. And wherever you're at in that real estate journey, you're never done learning. When you're done learning, you're simply done. And so I have found, I started out in the large educational groups that I mentioned, and they're all very beneficial. And today, 8-9 years later from when I started doing this, there's so many resources for the passive investor and the GP. There may be a little bit different focus, but there's numerous. This is a great podcast. There's many different meetup groups out there. There's tremendous amounts of sponsors, general partners that are putting content out on their web pages that can be downloaded. Get on LinkedIn. Just connect with a few people on LinkedIn, and your feed will become overwhelming very quickly. And so there are just many different venues. I think the technology today is great. It brings us the opportunity to do that. But I said in Rod Khleif's mastermind, because I think there's great value in nurturing those relationships, and I continue to learn about different approaches from the GP side.
That's excellent. So can you talk a little bit about the passive side? How did you get into that? Before we started the show, we were talking about some of your real estate holdings, which are pretty substantial on the passive side. How did you figure out what sponsor you wanted to invest with at the time and what markets you wanted to target? Or did you come across them on LinkedIn that you're talking about, or any other web pages you mentioned? How did that whole asset class start for you?
I'm a coach, as I said, in Rod Khleif's, and I think organization, and I have students today. They ask me, what's the process? What's the step-by-step? And I wish there was a consistent rule or a one-step process that fits all. But for your listening audience, it's really up to them as to how they want to go forward. I think, to me, those large multinational or those large educational groups were extremely beneficial because they taught me the process. They each have ecosystems of general partners and other fellow sponsors. So like when you went to college, you hung out with a bunch of college students and you were all learning at the same time. When you go to one of these, or a mastermind or a meetup or an online, you're with equally minded individuals. And so at any of those national groups, I went to the Summerot group where I began to associate. I did not want to be a general partner to start out with because I had a W-2 job and my time was limited, but I did want to learn the process. And so I found people, I talked to them, I interviewed them, I networked with them. I tried to understand the big picture from the educational group and then apply it to a specific sponsor, because part of the key element that every passive investor should take away, right, is one, education, but number two, and that is get to know the sponsor. Don't invest money unless you know somebody and understand each of those ecosystems of the educational groups have a little bit different twist to them. They're all great. None of them are bad. But I say that educate yourself, find the sponsors, but develop your personal strategy. What's your personal investment strategy? Anthony, I'm sure you do. I get many of them that come across my desk. I'll just say one in Topeka, Kansas, that's going to turn 25% IRR. I'm out. I'm not going to Topeka, Kansas as an LP or a GP. So hone your business, your investment strategy. Maybe you want a yield play. Maybe you only like value add plays. But every investor should develop their own strategy. I talk to students, I really encourage them to write it down on paper. And that way, when you see the email come across your desk for Topeka, Kansas, or maybe it's a Class D asset, heavy turnaround, no thanks, I'm out. Or maybe it's an 8% yield play for the next 7 years. Maybe that's your strategy. But encourage the passive investor to really, just as you would in developing a mutual fund, right? Whether you're going for high growth or an income, it should be the same way for your real estate investment to decide what is your sweet spot. And if you begin to develop your sweet spot of what you're going to do, rather than taking a shotgun approach or just looking at everything that comes across your desk, you're going to be much more likely to have a lot of success.
Right, and that's key too. When you figure out what your target investment criteria is, not only from the passive side, but even on the active side, your life becomes, I wouldn't say a lot easier, but it does become easier because you get to hone out everything else. Using me as an example, I go through my email, and like you said, Topeka, Kansas, 20% IRR. Okay, put it in the trash. Put this in the trash, and then I'll be left with maybe 5 deals I'll consider. And this is over maybe a month time period, going through my deal folder. And then it's kind of goes from there. Same thing with the passive investors. When they're looking at, deals to invest in or sponsors to invest in, I encourage my group to get on many different
platforms.
Operating partners lists so they can get their deals and figure out which ones make sense. And what I was going to ask you, Randy, is a little bit more on the process. You mentioned for the passive investors, you need to get to know your sponsor, which should be a no-brainer. Some don't, but it is what it is. What are some of the extra steps that the passive investors can take to get to know their sponsor besides the phone call? Hopefully in person. Sometimes that's not always possible, but are there any documents that are important that the passive investors should be aware of to ask the general partner questions on?
It's a great educational. It's part of the broad spectrum of the education. So I would say that yes, and yes to everything you just said. Back to the when you see something from, I'll say Seattle, Washington, you're probably going to say great, but I'm East Coast, that's West Coast. And the same thing for the passive investor starting out is kind of develop your strategy, develop that target market. But you say, Randy, I'm new at this. I don't have. You see 5 a month, I see 1 every quarter or something. So you really have to develop that and strategy and look at, I'm an analytical mindset. It's my reference point. Sometimes it's a weakness, but for the most part, I tend to be very analytical. So if you're only seeing 1 a quarter, schedule a call with them, ask the questions. Anthony or I could be happy to probably give you a checklist of things to ask for. What's their history? Just simply find out what is their history. How many assets have they owned? How many have they been involved in? What has been their return history to investors? Do they meet their pro formas? Have they paid distributions routinely? The other aspect that you mentioned is I find it's amazing to me that many investors will throw $50,000 at an asset without having ever read the private placement memorandum or the operating agreement. There is so much in there that differentiates a sponsor-friendly deal from an investor-friendly deal. And so let me just give you a couple examples, Anthony. In those documents, it talks about, are there, if you read the PPM, first of all, it's going to tell you every reason you shouldn't invest because it highlights all the risk. And that's good to inform you, but ask the sponsor some of those questions. But specific things I call out to new investors is, do you have any investor rights, any voting rights? There's a difference. Many people will say, as an LP, you have 0 voting rights. All the decisions are left to the general partner or the sponsors. And neither one of them is bad, but be aware. What is your in the unlikely event responsibility if there's ever a capital call? I have been in many and I've never had that yet, and I don't ever want to have one, but that means the property is non-performing and needs more injection of capital. And if that were to happen, you'll see there are documents written by some sponsors that say if you don't contribute, you basically lose your investment. There are others that say if you don't contribute, you're just going to get diluted we'll have to find another capital partner. Again, that's part of the educational process in being an intelligent investor. The other one this is Randy pet peeve, is what's the sponsor's history in producing their annual K-1s for tax returns? if you start doing this, you just find a world of difference between sponsors that are producing it within by March 15th as required by the IRS, and others that then fall into May, June, July, and you have to file an extension on your private return. It just breaks it down to, I always try to, as a passive investor, I always try to find deals that are what I would label as investor-friendly deals. Those that give the benefit of the doubt to the investors versus sponsor-friendly deals where everything seems to lean towards the sponsor a little bit, if that makes sense.
Sure, and there should be a healthy balance. And you mentioned a few items where, like the voting rights, not necessarily a bad thing, but be aware. Capital call could be bad. I personally have never had to call capital either, but figure out, ask your sponsor, what in the event for capital improvements are you budgeting per year? Are you holding a reserve? Is there an upfront reserve? You know, just so I'm aware. Like for us, we usually, you know, from the equity investment from the beginning, the capital's in that number. So we'll never, you know, hopefully never have to do a capital call, knock on wood, throughout the duration. So there's just, you know, they're not bad things. It's just things to be aware of, which I think is a great point that you mentioned.
If you really want to be active, then you start to really dig into some of the underwriting assumptions, right? Then you ask the sponsor as the LP, or maybe it's in their pitch deck that they put out. What are some of their underwriting assumptions? What's the rent and the expense growth assumptions? Okay, so I saw 15% rent growth in Houston, Texas. I think that's a little stretch. You know, what's the relationship with the property management company? If you're going to do third-party property management, or are you going to do your property management yourself? You know, these are multi-million-dollar assets, and the property management company is what makes or breaks the whole business plan. And so many people don't even ask or look at that. The CapEx, the reversion cap rate is a huge assumption in the business plan. So generally speaking, you know, if the sponsor is assuming that cap rates are going to continue to go down indefinitely, that's not bad, and none of these are bad, but just know your risk tolerance and what your investment objectives are. And I think if you see that and you see a deal, there's a tremendous amount of fees that are outlined in the PPM and the operating agreement, right? So there's a potential for acquisition fees, asset management fees, liquidation fees, refinancing fees, et cetera, et cetera. Some sponsors will charge a nominal rate, others will charge a higher rate. Maybe that higher rate is justified by their performance history. And I have invested in many of these different opportunities of all those things, but I know the sponsor, I know their history, I know I've been and seen their projects and even been invested in some of them. So it can be a lot of fun for the passive investor if you really want to be active and understand some of your risk.
Yes, and I've heard more individuals from the real estate industry actually transitioning more into, they're getting older in their careers anyway, so naturally they want to become more passive. But it's great to have, and you hit the nail on the head, the education beforehand. And then when you become, you know, a passive investor and you just want to live off cash flow, if that's your investment strategy, to just understand what questions to ask. Is there a better way for the passive investor? I mean, I'm on my website, I have frequently asked questions to ask sponsor. I have a whole section on it. What other, like, is there other, you know, forms of education? Because some of, at least my group, they don't work in the real estate industry. They, you know, maybe they work for an insurance company, or, you know, they work as a teacher. They don't know real estate. They're relying on the operator, which is fine if it makes sense. But how can we better, as general partners, educate the passive investor audience? Just what questions to ask, or not even what questions, just if we give them a PPM, they understand it, and they, you know, if they don't have any questions, then that's fine. But at least, how do we disclose all the risks a little bit better moving forward?
And I don't know that there's a one size fits all there, Anthony. I think that's back to every investor needs to understand their investment strategies. So, hey, like I'm sure you do, and I do too, have investors that know, like, and trust Anthony. And if Anthony gives them a deal and they've got money, they're just going to ship it to you. They're never going to read the PPM. They don't want to know any of this stuff. And that's okay if that's their investment strategy. And Anthony's probably got a great history to support that know, like, and trust. And I have a couple sponsors that I first started working with as a passive. I drove each asset. I looked at it. I asked 20 questions on a conference call. They send me a deal today. I look at it very little, and I either decide to invest or not as a passive because I know, like, and trust them.
Mm-hmm.
So I think the passive investor has to spend some time at it and building that. If I were to say one thing, let's go back to build that relationship with the Anthonys of the world when he sends you a deal. I've had sponsors, Anthony, I'm sure you would agree with this, that when I call them, they've sent me a pitch deck about an opportunity. I try to schedule a call with them to ask questions, and one, they don't either want to take my call or they only want to give me 10 or 15 minutes.
Red flag.
Huge red flag. Huge red flag. Yeah. And so there's just another indication. I've said I'm a fairly sophisticated investor. And if somebody doesn't want to answer my questions or hasn't got time for me, move on.
Yeah.
Find somebody else.
And that's a good point, because you know what level of service, if you even made the investment, you're going to get. And I hear a lot of sponsors talk about, well, I'm raising $10 million. I can't have calls with every $100,000 investor. Well, you know what? Hire an investor relations person to manage the calls. Figure it out, because this is part of their livelihood. They're trusting you to make good financial decisions for their capital. So if they just want to get on a 10-minute call, they don't even need to parade you with questions. Maybe they just want to know, hey, what do you think about Houston in this particular area? Like, you think it's going to be long-term, a success long-term, or are you guys thinking about holding the shorter term? Easy question if you know the deal. I can't tell you how many times that I've seen that mistake, especially with sponsors that are putting their deals out online. They're just looking for cash to come in quickly. I don't know. I just feel like, for me, because I invest passively too, I ask like a couple questions, and then
Sure.
I'm usually good, especially like you said, Randy, if you trust the person. So it's just a matter of, taking some time out as both the active and passive. Take some time out, understand what you're getting into on both ends. And from the active standpoint, after maybe talking to the passive investor, let's say you're oversubscribed for a deal, you may not want them, or they may not be a good fit for you. There's many different reasons why you should have a conversation instead of just taking the cash, especially. And the other thing you didn't mention, Randy, is, when you're looking in subscription agreements or PPMs, as a passive investor, I would look for any buyout provisions. So in the event you really had to get your capital back, something happened to your family, whatever, you needed some medical expenses, figure out what the provisions are, or at least what the mechanisms are in order to enforce that. That's another thing to look for. But yeah, there's so many different things to ask, and that could take place over 10 to 15-minute phone call. It's not that hard.
Otherwise, I say if you don't do some of those things, in my mind, you're really just speculating. You're like, multifamily is a good asset class, and I'm just speculating like I am when I buy a mutual fund. I want a growth fund versus an index fund, or et cetera. And there's nothing wrong with that if you're comfortable with that. Back to that strategy, and you're comfortable with that. And again, Anthony's got a great track record. Anthony's performed. I don't want to take the time, Randy. I trust Anthony. Okay. But if you're a newer investor, or you're looking at a new sponsor to build a relationship with a new sponsor, or even if you're looking at a new submarket, like, hey, if Randy came to an investor with a deal in New Jersey, you should ask Randy questions. Because I have never been to New Jersey. Well, I've been to New Jersey, but as an investor, I've never been to New Jersey, and I haven't looked at properties. Likewise, if Anthony goes to Seattle, Washington, his investors should probably ask a few questions about why Seattle and what makes them like Seattle, and et cetera, versus the stuff that's closer to home. Again, it can work very successfully, but know your risk, and it's buyer beware. And the other thing I would say is, Anthony, it's avoid the shiny object syndrome as the investor. So that's when an investor gets an email that says, 25, 30% IRR, Topeka, Kansas. And I'm not disrespecting Topeka. I just pulled it off the top of my head, but I don't know anything about Topeka, Kansas, other than where it's at. So it's speculation, and it's the shiny object syndrome versus having a strategy and knowing what I think I'm comfortable with as an investor.
And that's another important point you bring up, Randy. It's, the returns that the sponsor projects. You need, as a sponsor, I always try to underpromise and overdeliver. So when I see in my inbox, 24% projected ARR, delete, because it's just great. It probably will happen, maybe, if the deal's good and the operator's good. But I don't want you to tell me that's the return. I want it to be more conservative and something more realistic in the event things go wrong. So that's another point. And I don't think we talked about that.
Again, you're right. I agree. Under promise and over deliver versus the reverse. And buyer beware again. And so know the sponsor and their history and all those things we just talked about previously. It's a great asset class. It continues to form. I mean, the horizon looks good for this asset class for the foreseeable future. But the passive investor has to be active and to begin to educate themselves, if nothing else.
Excellent. Love this conversation, Randy. How can my listeners find you?
Anthony, the easiest way to first, thanks again for letting me be on the show. I really appreciate it. I think the easiest way love to talk to anybody who has a real estate question or comment, or just to chit chat. But the easiest way to get a hold of me is on my webpage. It's invest-arc.com, and there's a contact page on there. You can schedule an appointment, and would love to chat with you about whatever the real estate needs. If I can ever want to bounce an idea off me, or if you want to bounce a deal, or just anything I can help, Anthony, would love to get to know your listening audience on the East Coast.
That's excellent. Yes, and we'll have a link to your website, Randy, in the social media description and on iTunes. Definitely check us out. Give a rating and review to this episode if you liked what you heard and or saw today. It would really help Randy and myself get our message out to a greater audience. So we really would appreciate that. And Randy, thanks again for coming on the show, and look forward to talking to you again soon.
Great. My pleasure, Anthony.
Thank you.